Overall, I see some of the recent inflation readings as representing mostly a reversal of the unusually low readings of the second half of last year, rather than a break in the overall downward trend of inflation. With the economy coming into better balance over time and the disinflation that's taking place in other economies, reducing inflationary pressures on the US, I expect inflation to resume moderating in the second half of this year. But let me be clear, inflation is still above our 2% longer run target, and I'm very focused on ensuring that we achieve both of our dual mandate goals. So what's it mean for monetary policy? Now, it's important to note the many factors beyond monetary policy influence the economy and financial markets. These include global drivers of supply and demand, as well as factors that are currently affecting the supply side of the US economy that have been driving up GDP and job growth. Therefore, the stance of monetary policy needs to be considered in this broader context, and it cannot be understood simply by looking at the growth rate of the economy or by comparing the current interest rate to its longer run level, or what's often called R star. Looking at this broader context, the behavior of the economy over the past year provides ample evidence that monetary policy is restrictive in a way that helps achieve our goals. We're seeing clear and consistent signs that the imbalances between supply and demand in the economy are receding, and we've seen a broad-based decline in inflation. Overall, the risks to achieving our maximum employment and price stability goals have moved toward better balance over the past year. It goes without saying the outlook is uncertain. The risks are two-sided, with geopolitical events and China's growth outlook prominent examples. Because of this, we will continue to keep an eye on the totality of the data so that we make policy decisions and ensure that we get inflation sustainably back to 2% while maintaining a strong labor market.